How to invest in private equity. Private equity is a term that conjures up images of high-stakes deals, massive returns, and exclusive investment opportunities. But what exactly is private equity? And more importantly, how can you, as an individual investor, get a piece of the action? Well, that's what we're diving into today. Hi everyone, welcome back to the channel. I'm Dave Seymour. And in this video, we're pulling back the curtain on the world of private equity investing. Now, whether you're a seasoned investor looking to diversify your portfolio or just curious about this often misunderstood corner of the financial world, hey, you're in the right place. So let's jump in and walk you through the ins and the outs of private equity investments. Private equity at its core is about investing in private companies and businesses that aren't listed on public stock exchanges. Private equity firms raise capital from investors and use that money to buy companies, improve their operations, and eventually sell them for a profit. It's a world that's traditionally been the playground of institutional investors and the ultra-wealthy, but times are changing and there are more ways than ever for individual investors to access private equity investments. But before we get to those, let's understand why you might want to invest in private equity in the first place. For starters, the potential returns can be significant. While past performance doesn't guarantee future results, private equity has historically outperformed public markets over the long term. It also offers diversification benefits, as private equity returns aren't perfectly correlated with the stock market. But let's be clear, private equity investing isn't for everyone. It typically involves higher risk, less liquidity, and a substantial minimum investment. Understanding these factors before investing is, well, it's crucial. Now, let's explore 5 key ways that you can invest in private equity, starting with the most accessible and moving towards the more exclusive options. Private equity, ETFs, and mutual funds. The most direct way to invest in private equity is through a private equity fund. These funds are managed by private equity firms and invest in portfolio companies. Traditionally, these funds have been closed off to all but the wealthiest investors, with minimum investments often in the millions of dollars. However, some firms have begun offering funds with lower minimums, sometimes as low as $100,000 or even less. Here's how it typically works. You commit a certain amount of capital to the fund. The fund calls your capital over time as it makes investments. Now, as the fund sells its investments, it distributes profits back to the investors. The catch is these funds often have long lockup periods, sometimes 10 years or more. You need to be prepared to have your money tied up for a long time. Also, be prepared for high fees. The traditional private equity fee structure is 2 and 20 and a 2% annual management fee plus 20% of profits above a certain threshold. If you're just dipping your toes into private equity, exchange-traded funds or ETFs and mutual funds that focus on private equity, well, they can be a great starting point. The advantage here is clear. You can invest with relatively small amounts of money and enjoy the liquidity of publicly traded securities. You're not directly investing in private companies, but you're getting exposure to the private equity industry. Some popular options include the Invesco Global Listed Private Equity ETF and the ProShares Global Listed Private Equity ETF. However, because these are publicly traded, they may not perfectly mirror the returns of actual private equity investments. They're also subject to public market volatility, which can sometimes defeat the purpose of diversifying into private equity. Number 2, publicly traded private equity firms. A second, more accessible strategy option involves buying shares in publicly traded private equity firms. Companies like Blackstone, KKR, and Apollo Global Management are all listed on public exchanges. Now, when you buy shares in these companies, you're essentially betting on the firm's ability to make successful private equity investments. You'll benefit from their expertise in deal making and value creation, and you'll often receive dividends as well. The advantage here is that you're getting closer to true private equity investing while still maintaining the liquidity of public markets. You can buy and sell shares whenever you want. These firms often have diverse portfolios of private investments That gives you broad exposure to the private equity world. However, remember that you're investing in a management company, not directly in their private equity funds. Your returns will be influenced by factors like the firm's fee income and the performance of their public stock, not just the performance of their private investments. Number 3, private equity funds of funds. Moving into more direct private equity investing, we have funds of funds. These are investment vehicles that pool capital from multiple investors and then invest that capital across multiple private equity funds. The main advantage of this approach is diversification. Instead of putting all your eggs in one private equity basket, you're spreading your investments across multiple funds, each of which invests in multiple companies. This can help mitigate some of the risks associated with private equity investing. Funds of funds also provide access to top-tier private equity funds that might be closed to new investors. And they offer professional management. The fund of funds manager will handle due diligence, fund selection, and portfolio construction. The downside is fees. You'll typically pay fees to both the fund of the funds manager and the underlying private equity funds as well, and that can really eat into your returns. Minimum investments are also higher than for public market options. This often starts at around $100,000 or more. Number 4, direct investment into private equity funds. For those with more capital to invest and a higher risk tolerance, direct investment into private equity funds is an option. This involves committing capital to a specific private equity fund that will then invest in a portfolio of private companies. When you invest directly in a private equity fund, you're getting as close as possible to the action without actually buying and managing companies yourself. You'll benefit directly from the fund's investment performance minus fees. However, this option typically comes with some significant barriers to entry. Minimum investments are often in the millions of dollars, and you usually need to be an accredited investor. Your capital will also be locked up for several years, as private equity funds often have 10-year terms with limited liquidity. It's also worth noting that not all private equity funds are created equal. Past performance, investment strategy, and the management team's experience are all crucial factors to consider. Number 5, co-investments. Our final strategy is co-investing, which is essentially partnering with a private equity firm on a specific deal. When a private equity firm finds an attractive investment opportunity that is too large for its fund, it might offer co-investment opportunities to its limited partners. Co-investments often allow you to invest directly in a specific company alongside the private equity firm. This can potentially offer higher returns than fund investments, as co-investments often come with reduced fees. However, co-investing requires a high level of sophistication. You'll need to be able to evaluate the specific investment opportunity, which requires significant expertise. It also typically involves larger minimum investments and even less liquidity than fund investments. So there you have it, 5 ways to invest in private equity, ranging from the highly accessible to the more exclusive. As you've seen, private equity investing isn't just for the ultra wealthy anymore, though the most direct forms of participation still require significant capital. Remember, each of these strategies comes with its own set of risks and potential rewards. Private equity investments can offer the potential for high returns, but they can also typically involve higher risk and less liquidity than traditional investments. Before making any private equity investment, it's crucial you do your homework. Understand the investment strategy, the fees involved, the management team's track record, and how the investment fits into your overall financial plan. It's also worth considering your investment timeline. Private equity is typically a long-term gain. More liquid investments might be a better fit if you need your money in the short term. We've covered a lot of ground here today, and we want to hear from you. Have you had any experience with private equity investing? Are you considering it for your portfolio? Drop a comment below. Let us know. Let's open up some dialogue. If you found this video helpful, please give it a thumbs up. Subscribe to our channel for more insights on investing and personal finance. Don't forget to hit that notification bell so you never miss an upload. Until next time, here's to smart investing and building long-term wealth.